Between meeting payroll, keeping customers and clients happy, and frankly, maintaining your own sanity, owning and operating a business is not an easy thing to do. And so you'd be immediately forgiven for not making tax planning a top priority of yours as you're trying to juggle all of these things at once. But the focal point and focus of this video is just that: tax planning for business owners, and specifically highlighting 3 strategies or concepts that, as a wealth advisor, I often see or find that business owners miss out on, or just simply overlook or aren't aware of. Immediate disclaimer: there's a variety and host of different tax strategies that business owners can employ. And really, when you think about the way that the US tax code was written, it really brings and focuses on small business owners or any business owner and keeps them in mind and offers a lot of advantages and strategies they can employ. That's why an important caveat I always lead with is that, as a business owner, a great friend or someone to contact or work with is a really good CPA or tax preparer who can help you identify some of the things that you could be taking advantage of. As a wealth advisor, I kind of wear 2 hats. It's, I think, really helping business owners identify some of these strategies or things they should be thinking about, but then also trying to differentiate and really separate almost a business owner's personal balance sheet from that of the business. And especially when you're launching or the first few years, obviously there's going to be some kind of commingling. You're putting probably a lot of your eggs in one basket to build or grow your business. Totally understandable. As the cash flow of the business picks up, though, you're starting to hire more employees, and really you're not as worried day to day that things that the ship is going to go under. Focusing more on your own balance sheet and really your own kind of personal financial goals can be really important. And so that's why these 3 kind of tax strategies or tips I think could be helpful for business owners to keep in mind. Okay, first and foremost, I think a strategy or concept that business owners very often miss out on, and for good reason, I understand, is just simply not contributing to retirement plans. There's really 2 reasons as a business owner you might consider funding a retirement plan, like a 401k or a SEP IRA or simple IRA. The reason is that it builds up your net worth outside of the business and really kind of diversifies your risk of, instead of having the business being your only asset or largest asset, it probably will be anyway, but it diversifies you out of that somewhat to then build a more diversified wealth almost outside of it. On top of that, funding a 401k or some other comparable retirement plan reduces your taxable income in the present year. And when you have a W-2 salary you're taking from the business and maybe profit distributions as well, maybe that's pushing you into higher tax brackets. If you can defer some of those taxes and kind of kick the tax can down the road to maybe retirement when you're in a lower tax bracket, and you can pull the funds out of the account at that time, paying taxes on it in that lower tax bracket, that can just be a really good tax play or something to consider over time. So really, it's just that immediate tax benefit in the present day, and importantly, diversification out of the business for your net worth. I totally understand. You're probably screaming at your phone or computer screen saying, well, I put all my money back into the business. And maybe you do, and maybe the strategy isn't right for you. But I would suggest it's something for especially those who are looking at an exit in the next 5 to 10 years from their business. Start diversifying now. Start building up assets outside of the business now, especially if it's a healthy cash flowing business. You feel like you have a decent amount of growth and that reinvestment isn't as necessary as maybe it once was. Investing in workplace plans can be great. And I'll also add, it's even a great retention option or incentive to keep employees around if they also have access to something like a 401k plan through work that maybe you're funding at some amount over time. Okay, in a similar vein, tax strategy or tax tip number 2 for business owners, or things that they miss, is to fund and invest a health savings account. It sounds very specific, I'm sure. You're like, why the heck are you even mentioning this? The reason is that an HSA or health savings account offers what's called a triple tax benefit. I've done a ton of videos on this. I'll try to link one maybe here or in the description. But basically, it offers a triple tax benefit in that you get a tax break for funding the account today. You can invest the proceeds that you've invested or contributed to the account so they can grow tax-free over time. And when you go to withdraw funds from the account, your HSA, likely in retirement, you can withdraw those funds tax-free if they are paying for current year medical expenses or reimbursing yourself for prior year medical expenses as well. That's often a thing that people miss. Even if you don't use it as for any of those things, maybe you grow the account to some large balance that you could never reimburse yourself for all those funds, you can treat it just like an IRA or other tax-deferred asset where you're pulling funds out for any purpose. It's just taxable income in later years. So HSAs can be a really powerful savings and investment vehicle. I typically encourage people to treat it like a healthcare retirement account almost, especially if you're thinking about retiring early. You want to sell your business maybe at 55 or 60. There's going to be some period of gap years where you're having to pay for private healthcare insurance, likely. And you're not going to become eligible for Medicare or other government programs until you turn 65. So you often find early retirees funding health insurance that can run $2,000 to $3,000 per month, per couple, per year, for the year, depending on the amount of care that you're paying for. That can get very expensive. So having that HSA there as kind of a buffer or kind of a supplement to cover medical expenses, maybe get a higher deductible plan in those years where you have a higher deductible, but you have your HSA to kind of cover whatever those deductible amounts might be. It can be a really, really good tax play in the present year and a really good early retirement vehicle in later years as well for those business owners looking to exit at some point, maybe that earlier retirement than a lot of people might think of. Okay, third and final point or strategy or tip or even, I guess, tax trap is a way to think about it, is just justifying write-offs or expenses just because they are a tax deduction. I feel like social media has now led to this influx of really horrible tax advice. One of the big ones I've seen is, I'll buy a private jet or I'll buy a new car or something as a tax deduction on December 31st of that year or whatever because I had some big tax event. That's typically not great advice in running your business, and I'll offer that because we have this adage in financial planning or wealth management or even accounting, just to not let the tax tail wag the dog. Just because there is some tax benefit to be derived from buying something that you're going to expense does not mean you should buy that thing. At the end of the day, spending money is spending money. And it maybe if it's good for your business, that's great. If it's just simply something you're like justifying for, I'm going to write it off, that's not necessarily a good use of capital and a good use of your funds. And so that's something to keep in mind on an ongoing basis, I think, importantly. An added caveat to all of this, again, to reiterate, hiring a really good CPA or accounting firm that can help you in differentiating some of these expenses as justifiable or worthwhile versus not, I think is well worth any expense that might be involved. The last point, I think that doesn't even get that brought up for a lot of business owners, is that the value of your business is very often derived from whatever your kind of bottom line number might be, whether that's net income on your income statement, EBITDA as an acronym for earnings before interest, taxes, depreciation, and amortization. That's an acronym thrown out often when it comes to business valuation. Those metrics can be directly attributed to the value of your business, are very often dictated by the amount of expenses that your business has. Literally, it's revenue less expenses is my profit. That's a very simplified version of all of this, but the more expenses you're taking to save taxes in the present day, it's lowering whatever that bottom line metric or number might be, and that then lowers the value of your business when it comes time to sell or have a liquidity event. So I offer that or throw that out as something to think about, especially in kind of those later years when you're starting to plan around succession or exiting a business. It's probably worth your while to take a hard look at expenses and think, how can I lean up this business or become more efficient to, in turn, when it comes time to sell or assign a value to my business, to then receive a higher value. Any tax benefit you receive today likely is not going to be outpaced or beaten by having a higher value and a net receipt from the sale of your business in later years. So that is 3 quick tips. I know this is by no means exhaustive. There are tons and tons of opportunities for business owners to take advantage of tax planning in the present day and well into the future, and things they can do today to plan for the future. Again, hiring an accountant or a good advisor to work with you on some of these strategies can go a really long way in identifying what those are and really separating your personal balance sheet, again, from that of the business. I'm, again, Scott Sturgeon, Senior Wealth Advisor for Oriada Wealth Partners. If any of this is interesting to you, I put out a newsletter every 2 weeks. It covers things from estate planning to investing to tax planning and everything in between. There's a link to that in the description below. It's called Views from the Top. Also, if you're interested, I offer free consults and can help you kind of identify whether working with Oriada Wealth Partners on things like this could bring value to your financial situation. There's a scheduling link to my calendar below in the description as well. As always, thank you so much for tuning in. Have a great rest of your day.